Good morning, traders and investors. Roger Scott here, senior strategist for The Trading Pub. It's Monday, it's September 25th. It's about 7:35 in the morning. The market's going to gear up to open up in just a little bit less than 2 hours, about an hour and 55 minutes to be at an hour and 34 minutes now to be as specific as I humanly can with you. Humanly can, not humanly can. Got to get my language straight. As you can see here, the Nasdaq, the S&P, they're all opening down just a hair. This is randomness. This is nothing here nor there, which is telling us that the global markets are not putting too much pressure over the weekend on the U.S. market, which is positive. That's a good sign. Now, I'm gonna. By the way, I'm getting too started too hot here. Before we get too deep into this video, make sure you subscribe to our YouTube channel. That's the Roger-Scott YouTube channel. Like our channel. I post those videos, and you can get them there as soon as they're uploaded. You'll get an alert if you hit the bell and subscribe to the channel. Don't forget to hit that bell. Also, either above or below this video, depending on where you're watching it, you'll find a link to my VIP room, which happens today at noon, where I go over trades, ideas, hot trades, give you all the red meat you could possibly take in. And I've opened it for the time being. I'm going to close it pretty soon, but I've opened it for the time being for everybody. You can get a really good second part of this video live, and you can ask me questions. That's happening at noon, Monday through Wednesday, and Eastern time at 11 a.m. Thursday and Friday. Now let's get into all of the details here. All right. Now, and I'll give you an update on Carvana before the end of this video, so don't go anywhere. The Carvana update for today, so you'll understand exactly why I'm doing what I'm doing, what I'm looking at. It'll happen in this video, and I'll post that in the Telegram channel as well. Make sure to subscribe to our Telegram channel, rogerscott.com/Telegram. All right. I did that in about a minute. So as you can see here, we're opening up just a little bit lighter today, which isn't very significant. Now, a lot of folks are worried about the market and are worried that we're going to be coming down further. That's why I want to analyze this. And this will have a lot, this will go hand in hand with my analysis of Carvana, because Carvana is actually extremely correlated to the U.S. stock market, to the big S&P. You could see right here that it's doing almost exactly the same thing as the QQQ. I mean, it's like note for note, tick for tick. They're not that different. But getting back to the S&P 500, the big question this week, and we're going to have a lot of Fed data this week, a lot of Fed data. And Fed data hasn't really been coming out bad. And the last statement the Fed said wasn't really anything that nobody was paying attention to. So the question is, are we going to break below this level right here and go down to the 200-day, or are we going to come back up? Now, typically, I'm a momentum guy, but there's a couple of things that are causing me to pause and say to myself, hold on a second. We're overdone, and this should have a nice, good, healthy pullback, taking us above the 100-day moving average, and I'll explain to you why. First thing, long-term trend lines, long-term support and resistance level trump moving averages. It's actually the only thing that trumps moving averages. And here we have a 3-point support level. Also, in the last 3 months, which is how long this is, the S&P hasn't changed fundamentally. There hasn't been really a major economic shift. We haven't seen any major credit issues. We haven't seen any global turmoil that's unforeseeable. I mean, anything new that we haven't seen before. There's nothing new on the horizon. And I personally think, and again, nobody knows for sure, but I personally think this is an overreaction to the Fed based on them saying rates are going to go higher for longer. Well, I got news for you. That was the case beforehand. Nothing really changed. I mean, maybe a few traders didn't realize that, but this is nothing new. This reaction is nothing new in terms of what we're expecting. When the Fed said we're going to have rates higher for longer, I imagine most prudent money managers who know what they're doing were like, yeah, that's kind of where we thought. So I'm not seeing this reaction as being anything new. Moreover, a year ago, we were in a much worse situation. The Fed was raising rates 0.75 at a clip. Now they're raising 0.25, and we're near the end, not the beginning or even the middle. We're near the end. So to me, I don't see the reason. I don't see the logical reasons. We don't have earnings. We don't have any major Fed data today or tomorrow. I don't see any major fundamental reason why the market would drag down. It would have to be technical action, but I'm not really seeing any selling pressure on major sectors. I mean, we're down 0.8 today. So that's two things. So we have major support. Nothing changed fundamentally. Now, third thing, all right, this support level more likely than not will hold because, again, nothing changed in the last 3 months. Now, take a look at this trading action right here. Do you see trading action this severe? Look at this. 3 down days of selling. All right, well, we have a little bit here, and then what happens? We got 1 or 2 here. We got 3 here. We got a couple here. You don't have 3 continuous days of selling unless something really crazy is going on. Look, even here, 3, and then 4th, it starts coming right back up. 3 right here. So my point is, I think the market in short term is oversold. Moreover, and this is the last thing I'm going to tell you, if you look at the QQQ, right, at the SPY, we're also grossly oversold. Matter of fact, if you go this far out, we haven't been this oversold. Look, let's go further. We haven't been this oversold since right here, since this. So to me, the market really needs to pull back. Now, does that mean the market is going to pull back and make new all-time highs? No. I actually am more bearish than bullish, but I think it's overdone in the short term, and I think the market needs to have 2, 3, 4 days up before going down. And if you look at the QQQ, which is down even less, 0.3 today, it's holding this really well, and it's got the same oversold territory, and we haven't been this, and again, I'm just pointing this out to you. We haven't been this oversold since right here and right here, and each of those times we bounce back. We bounce back. So again, am I expecting a major bounce higher and an all-time high and bull market resuming? Absolutely not. But do I think we're going to jump up for a couple of days and flirt with the 100-day line, maybe even the 50-day moving average? I do. And that takes me to my update on Carvana. Carvana is a large cap stock. It's highly correlated to the S&P and the Nasdaq. And you can see here, the trading action today is all, and the trading action last 3-4 days is almost identical. Moreover, this stock has been going down for several days straight. It's also oversold. So to me, and you can see here, these trading things don't act forever. They come down and then they start coming back up. So if the market pulls back up, I'm expecting this stock to go higher. I'll update you later in the end of this video on what we're going to do with this stock and how I feel about it. But I wanted you kind of connect the dots and explain to you why I'm hesitant to cut cut Carvana when I think the market's going to come up. If the market was to come down, that's it. The soup is over. But I actually think we're going to poke out, hit some stops, and come back up. Because Friday's action, this trading action that we're seeing right here, this was, here, let me just show you here. Buyers stepped in. This is buyers stepping in. This is very choppy trading action over Friday. So buyers come in and buyers coming in. It's not a straight up listless sell. So again, let's not look at the small picture in light of the big picture. The big picture isn't looking all that bad. It's actually looking a lot more choppier, especially in light of where we're at now. There may be something that I'm not aware of that's happening in the world, but if I'm not aware of it, the market's not aware of it either, because we're pretty much flat overnight. Crude oil right now is higher. It's hugging the 8-day EMA, which tells me we're going to come back up and move higher. So we may get some love from the blue chips. And by the way, oil has been outperforming the S&P 500 really, really well. You may want to go into the oil market. Now, let's talk a little bit about the global economy and put everything together. But I wanted to give you my take on the S&P and why I'm stubbornly holding NVIDIA. I keep saying NVIDIA. We're holding NVIDIA too, but NVIDIA we have a long time with. Carvana, we only have a few 4.5 days left. So I think this downside will hold and we're going to bounce. That's my thesis there. All right. The US 10-year yield rose to a 15-year high, which is one of the reasons why the market cooled off. But again, this is not unexpected. Market participants are looking ahead to the release of Fed's favorite inflation gauge. I'll talk about that in a second. In Friday's session, Wall Street major averages closed lower. S&P is now at a 3.5-month low, and Dow is now at a 2.5-month low. And typically, remember, the stock market is not a trending market. It's a reversion to the mean market. It's a yo-yo. So I'm expecting a bounce. Economic data on Friday showed global manufacturing was better than expected. Global services were lower than expected, and that took an edge off the market. Now, here's the interesting part. Michelle Bowman indicated Friday that she leans towards increasing interest rates again. I continue to expect that further rate hikes will likely be needed to return inflation to 2% in a timely manner. Agreed. Bowman also said, Collins said further interest rate hikes were certainly not off the table. Dolly said that she's not ready to declare a victory in the battle against inflation. Emphasizes central bank's commitment to curbing price pressure as gently as possible. It's right there. It's straight up right there. U.S. futures have a 25% probability of a 25% base hike. I don't think it's happening in November at all. But what do I know? But in December, they're talking 35%. I would say based on what they're saying right here and what the dot plots are looking, I think those odds are even higher. The big data we're going to have this week is U.S. Core Personal Consumption Expenditure Index. That's what they're looking at. That's a big, 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 big number. They're also going to be looking at, consumer confidence, new home sales, core durable goods, good orders, crude oil inventories, GDP, initial claims. There's a lot of data to process. So let's not throw away the towel. Moreover, we've got earnings on chips. We got earnings on consumer staples and discretionary, Nike and Costco and Carnival. So there's a lot of things on the table this week, but I want to market show its hand. Europe is down this morning as investors concerned regarding the potential for investor rates to remain elevated for an extended period of time, while continued apprehension about Chinese economic growth weighted on sentiment. Losses in mining stocks are leading the market lower. China closed lower as renewed concerns over the country's property developers exerted downward pressure on market sentiment. Not good. But again, the U.S. stocks are holding well, and most of that is old news. This is nothing new. We know about this. Japan closed higher, snapping a 4-day losing streak as investors scooped up beaten down stocks. Healthcare stocks outperformed on Monday. And Nike's down, Open Technology is down, Sealed Air is down, Dow Chemicals is up 1, and Urban Outfitters is up a little bit. Bottom line is there's nothing really crazy going on in the market. Sectors, if you're looking at the sectors, you will see that utilities, energy, financial, healthcare, Dow, blue chips. Tech has been taking it under the chin. Technology's down here. We painfully all know that. QQQ, basic materials haven't been doing well. Industrial hasn't been doing well. Retailers haven't been doing well. Home builders haven't been doing well. Utilities, energy, financial, and healthcare. That's where the market, the money's moving to, into the blue chips for defensiveness. But again, I think we're a little bit overdone. So let me give you a day trading stock for today, and then I'll give you a quick update on NVIDIA. Carvana. Why do I keep saying NVIDIA? So NIO and all the other car stocks are down quite a bit this morning. Now, the stock is in a downtrend, so it's not necessarily the best stock right now. But for day trading purposes, you see how it's taking out the high right here? Here's what you do. You wait till 10 a.m., 30 minutes after the opening bell, and you look at the high of the day, and you look at the pre-market high. If we want to trade above the 10 o'clock high, in other words, if the 10 o'clock high is the higher than the pre-market high, you go long. If the pre-market high is higher than the 10 a.m., you put your buy stop at the pre-market high. You could look at extended hours right here. You could just take that off or put that on. So you could see it right here and just clock the high that happens before 9:30. And if after 9:30 we don't take out that high, well, that's the high. If we take out that high, 10 a.m., don't do anything till 10 a.m. because if the market goes down, this will probably, go down with it. So that's what I think there. Carvana, we are at support. On Friday, we were higher. We made a higher high and we closed slightly like 97 low here, and here the low is 97 cents higher. It held better than the market. Relative strength is better. Right now, we're sitting right at that low level, and it's going to be very interesting, but the market's going to be very instrumental in this. If we start breaking down in the stock market, in the QQQs, and we're not going to catch any bids, we got to get out of Carvana today. It's for the best. But if the market starts catching a bid, maybe even second half of the day, I'm going to wait till the end of the day. I want to see if the market starts catching a bid and starts churning higher, which I think it's going to do. Then we have a couple of days to liquidate this position and possibly get out of it unscathed. So I'll keep you updated as the day continues and let you know everything that's going on. Before I let you go, it's finally time to reveal Wall Street's best kept trading method. It's a backdoor. Folks, You gotta love backdoors, right? People love backdoors. I mean, I love backdoors. It's a backdoor method for targeting nice income on the side. You won't see it anywhere else, not on CNBC, not on Fox Business, and certainly not anywhere else on the internet. Join former market maker and legendary trader Jack Carter, along with option strategist Lance Ippolito at 1 p.m. Eastern Time to hear all about it. It's going to be right after my VIP room. I'll even give you a link when we're there to remind you. It's happening at 1 p.m. today. Don't forget about it, and keep your eye on my Telegram channel. I'll be updating you on Carvana throughout the day if I see anything different, and I'll probably be updating you no matter what. And I'll see you in my VIP room. It's happening at noon today. Link above or below this video. If you can't find it, go to the YouTube Roger-Scott channel, and you'll find it below this video. Bye. Have a great day, and let's keep an eye on Carvana. NVIDIA I'm not really worried about because we have quite a lot of time left. But Carvana I am, and I'll be giving you guys a tier 1 trade today, a lower risk trade at the end of the day for the Option Weekly program. I'll see you guys later. Have a great, great day.